there was the report on the Baku to Belém roadmap, during which I had the opportunity to speak about this initiative of transformational finance that was welcome by the COP30 presidency. But first of all, thank you everyone for being there on the IDFC pavilion, the pavilion of the public development banks. 27 public development banks committed to strengthen the Paris Agreement and climate finance in general. I'm very happy to welcome my 5 extraordinary panelists here to discuss about an important topic. As I told you, it's at the center of climate finance. This concept of transformational finance and this coalition making finance work for climate that we launched, and that brings now more than 1,000 leading public and private, and I think it's very important, financial actors from both developed and developing countries, including, of course, the International Development Finance Club, the Financing Common System, the network of the 500 public development banks all over the world, but also UNEP-FI, the Principles for Responsible Investments, and the Mainstreaming Climate in Financial Institution Initiative, and last but not least, in collaboration with the Green Climate Fund, all friends here. Collectively, this organization represents over 40% of global financial assets. And as such, the initiative serves as a unique whole-of-finance platform that coordinates action and consolidates input into global climate finance processes. The initiative has been actively engaged since 2024 in contributing to the main climate finance discussions under the UNFCCC, including the NCQG and the corresponding Baku to Belém roadmap, as well as the Sharm el-Sheikh dialogue and the implementation of Article 2.1c of the Paris Agreement. Through its work on transformational finance for climate, the initiative calls for a system-level approach to finance, emphasizing not just the scale, but also the quality and strategic deployment of finance, in particular that managed by public development banks, commensurate with the challenge at hand and the urgency to act. Moving from projects or transaction-level outcomes to more systemic, cross-sectoral, whole-of-society effects, transformational finance for climate is about making every unit of finance work harder for a systemic change beyond incremental improvements, so that countries get both the volume and the impact they need based on their strategies and their plans. The initiative also highlights the complementary roles of different public and private actors and the collaborative potential in delivering finance that help unlock deep catalytic change for low carbon and resilient developments. We're gonna have today 2 different panels. And the first one, for the first one, we're going to discuss. Is it working? Yeah? Yeah? Okay. For the first one, we're going to discuss transformational finance for climate. What is it? And why does it matter? And I have the pleasure to welcome 5 panelists. The first one, Mr. Remco Fischer, Clim Lead at UNEP-FI. So Ms. Sarah Bendaou, who was supposed to represent mainstreaming climate in financial institutions, will not be able to join us, but I trust that she made a statement, and Alexis, you will be able to report it. Ms. Eva Meyer for our Senior Environment and Biodiversity Specialist at the European Investment Bank, and Ms. Jen Sendemund, Team Lead and Senior Policy Analyst, Development Cooperation Directorate at OECD. I'm going to start by Remco, asking you the question. First, thank you so much for all the work UNEP-FI is doing and for the driving that you give to this coalition. It's really important to count on you. But I wanted to give you the floor to give us an overall presentation of the Transformational Finance for Climate Group work and position paper that is released for this COP30, and maybe give us a little bit of the private sector perspective.
Yes, thank you very much. Can you hear me? Am I audible? Great, thanks. Thank you very much. And as you say, yes, I lead the climate change work for UNEP Finance Initiative. UNEP Finance Initiative is a network, big platform of financial intermediaries, financial institutions that's facilitated by UNEP, focused on sustainability topics, nature, climate change, other topics. Our membership is, interestingly, mostly private sector. I said that. There's some public institutions also in our membership, but our work really is focused on private finance. And interestingly, and I want to highlight this, our network is 50% developed countries and 50% developing countries in terms of the private finance that we represent. And we've been looking for ages at how can we get our members and the clients of our members and the portfolio companies of our members to channel more, to rechannel finance away from Paris misaligned activities, both on the emission side of things and also the resilience side of things, and more towards Paris aligned activities. And of course, we've been also engaging, with the finance process here. And to us, at this point in time, the most promising answer to that question of how do you do it, how do you mobilize private finance, how do you mobilize our members, commercial banks, institutional investors, to really rechannel finance, is the concept of transformational finance, which is the core focus of our collaboration, the collaboration that Nicola, you presented. What's the backdrop of this? Climate finance globally. The picture is not that bad, globally speaking. We have 2 trillion as of 2023 of quote-unquote climate finance flowing. And that's not, and there's been a lot of growth from 2020. This is again 2023 data. We had a lot of growth from like 2019, 2020 to 2023, roughly 26-27% in growth year on year. And if that growth were to continue, we would probably by 2028, 2029, 2030, start reaching globally amounts of climate finance that are globally needed. The other good thing that we can see at the moment is that of those flows, roughly half is developed in developing countries. It's a lot better than you'd expect it to be. And the third good thing that we're seeing in the data is that the ratio between public and private is shifting, and it's more and more private, which is the right direction. Because if we want to mainstream things in the economy, that's not going to happen through public finance. That's going to happen through private finance. Public finance, super important role to play. I'm never going to say anything but that. But at the end of the day, shifting economies and markets is going to happen through big volumes of private finance. What is the bad news about in all of this? Number one, adaptation is really small, too small. Most of what we're seeing is mitigation, and this is widely acknowledged and everyone knows this. We should also, though, admit that measuring adaptation finance in private markets is a lot more difficult, and a lot is not being measured. But what is the biggest problem? The problem is that of the 50% that's going into developing countries, it's not a problem, it's just a phenomenon that we need to work on. Something like 70% is China. And the rest of the developing world is mobilizing only the 30% of the 50%. And international and of that, what's internationally mobilized is 200 billion as of 2023. And that's so the challenge before us is we've got some good stuff going, we've got some bad news. We need to grow the internationally mobilized finance for developing countries from 200 billion to Baku to Belém, NCQG target 1.3 trillion by 2035. That is not a quintupling, that is more than a quintupling, right? That is a, what's the word? Six-tupling, seven-tupling, I don't even know the English word for it. That's the challenge. Okay, how do we do that? How do we design the NCQG and, other things in a way, and how do we deploy public finance from the north so that we're not tripling, we're not quadrupling, we're not quintupling, we're going from 200 to 1.3 trillion in something like 10 years. And the answer can only be, there's no other answer. We need to think about transformation. Because what's working in places like, still in the US we know is having problems, but in the last from 2020 till 2024, a lot of climate finance was mobilized. In China, how do they do that? Transformation, systemic shifts that really unlock it. And that's what this coalition is all about, is to say, what does that look like? And it basically, it boils down to, we need to get to the NCQG to a place where it continues doing also the project stuff, like the blended, the guarantees and the first loss equity and all of that is good, we need to absolutely also prioritize public finance where private finance simply cannot go and has not an appropriate role to play, public good, etc., etc. But then what we need to do is basically decentralize the mobilization of finance, make it systemic. How do you do it? By mobilizing the private sector, by shifting the private sector. How do you do it? In countries where there's a private sector. This is not going to necessarily work in FDCs, this is not necessarily going to work in SITs, but it's going to work in most of the developing world. To say, we need to do things that shift the risk-return ratio for private investors. Private investors operate on risk-return. I'm giving you money, that's a risk for me, I'm expecting a return from you that compensates me for the risk. At the moment, and still historically, the risk-return ratios of Paris-incompatible investments are still superior to the risk-return ratios of Paris-compatible investments. A lot of the developing countries that we say need more climate finance have no problem attracting other non-climate finance, like other forms of private capital. Why? Risk-return. We need to shift that. How do we shift it? It's not hard. We need systemic interventions, typically policy, regulatory interventions, strengthening of the capacities of institutions. The textbook example, if you ask an economist, is going to say, well, put a price on carbon. Sure, if you do that, magic can happen. Or the list goes on. There's many, it's not only a carbon price, there's many things that you can do. Subsidies, standards, energy efficiency standards. And of course, doing that, and then it's my final point, doesn't require you to, the amount of money that costs is basically the money that it costs to build the capacities of developing country institutions, to draft the policies, to enforce the policies. It's not cheap, but it's a lot cheaper than using the public purse to be going out there and project by project, having to do the investment. Guarantees are good, a lot better, but even they are going to be too project specific, and we need to complement that again with a systemic approach. And with that, I stop and hand it over. Thank you.
Thank you so much, Remco, as always, super clear, and thank you for highlighting the necessity of having complementarities between public and private. As you have rightly said, we are not going to bridge the 1.3 only with public resources. We see that it's decreasing, so let's focus them on where the private sector cannot go and create the opportunities for the private sector to crowd in where he can, when he can. So thank you so much. This is really, it was a really good snapshot of what we are trying to do with this coalition. But we spoke about private. Now let me turn myself towards Eva Meyerhofer, because you are representing the EIB and more globally the multilateral development banks that have a crucial role to play in this transformational finance. You work a lot on the quality of climate finance and the promotion of systemic climate outcomes and impact. Could you tell us a little bit more about it?
Thank you very much. And I think a lot of what Remco said does resonate with us as multilateral development banks. And the multilateral development bank community, I think, has been a big contributor to climate finance. So how do we move? However, I think one of the issues that Remco mentioned is not only do we need to mobilize additional resources, but with the resources that we actually are mobilizing, is it achieving the targets and the impacts? Because it could very well be that we are mobilizing a certain amount of resources, but they're not actually, and especially in the climate adaptation field, you're absolutely right, this is an issue. So maybe, yes, we don't have a lot of resources going towards climate adaptation, but the impact may be quite large. So I think, so how do we shift then to accelerate really the quality and impact of climate finance? We need to look, one, at strengthening the effectiveness of MDB climate finance, and then also driving systemic economy-wide climate and nature outcomes. I come from the nature space, so you'll have to forgive me when I keep on making that nexus. But so we have been looking in the last couple of years. I mean, we've been reporting on our climate figures since 2011. And now we are shifting actually from volume to quality of climate finance. And so what we need to look at is how do we ensure that every dollar or euros that we deliver is demonstrable mitigation, adaptation, and resilience outcomes. So we've been working on clear and harmonized climate impact metrics across the MDBs so that these impacts are comparable, credible, and traceable. We've been looking at robustly validated baselines and transparent assumptions, especially for GHG reductions, adaptation benefits, and avoided nature loss. And then looking, of course, I think Remco, you mentioned that a bit, is the ex-ante impact assessment. So we understand expected climate benefits before approval, and then the ex-post reporting, which we are not always very good at, so that we know what actually materializes. We often, when we look at the climate finance tracking today that we do, it's always input-based, right? We don't really follow up on the outcomes and on the output. So quality also means ensuring climate finance is accessible, catalytic, and aligned with countries' own climate and biodiversity strategies. And then to unlock that transformative change, we must move beyond project-level finance. I think that's very clear. And support system-level transitions that countries need to achieve their NDCs, their long-term strategies, and their nature commitments. So what we've been doing as an MDB collective is supporting policy and regulatory reforms that shift whole sectors. A lot of the work that we do with the greening of the financial sector and that whole network of central banks, but also looking at the sectors themselves, so energy, transport, agriculture, water, towards low carbon and climate resilient pathways. And then crowding in the capital. So yes, we do need to continue using de-risking instruments anchored in transparent impact frameworks and embedding, and here I have to make the pitch for nature and biodiversity considerations into climate operations, because the nexus to resilience is absolutely key. So recognizing that climate action cannot succeed without protection and the enhanced resilience of ecosystems. So the central role of climate and nature impact metrics what will it do? Enable us to measure what matters, not just what is easy to count. It strengthens accountability, giving confidence to governments, investors in particular. So we've seen that where we have issued certain bonds, where we have issued we've done our first debt conversion, investors ask for what are the impact metrics that we are using. It creates a certain amount of confidence amongst the investors, but also accountability towards our citizens. It drives alignments across the MDBs, bilateral finance, certainly with the IDFC community, but also private actors, and connects, of course, for us, what is important is also climate and nature. And what is key, of course, I mean, we've got so many different frameworks out there, is to find simple, decision useful, and interoperable metrics. And this is what the MDBs have been working on. On the nature side, we just launched our nature finance metric guidance yesterday, which will hopefully help investors, but also link and be able to scale up financing for climate and nature. And this is very significant. What we'll do is, we've got very good, strong principles on the tracking side, but it'll also bring increased rigor in terms of climate finance impact. And I'm going to stop there and pass on to the next speaker.
Thank you. Thank you so much, Eva. I think it's what you said is super important, notably in the context of decreasing public resources. We need to demonstrate that the public money that is used create impact, and for this we need really to have concrete metrics and reporting. And I wanted to mention, you alluded to it, but the work we are doing on the common principles for mitigation and adaptation. It's a set of principles that we agree on with IDFC and with the multilateral development banks. It's something key that is also available for the private sector. You also mentioned the necessity to work on system level transition, and it was a really very good complementary of what Remco said. So thank you for this. I'm now turning myself towards Mr. Jens Sedemund. So you are the team lead and senior policy analyst at OECD. I wanted to hear about the fact that you're addressing the finance scale-up and alignment goals of COP decision and processes. What should be the role of catalytic interventions?
Many thanks. So I think there'll be some repetition of what we heard here before, because it seems like we have a high degree of agreement here.
Which is good.
Is good, absolutely. But let me just premise saying, that my focus is particularly on developing countries where the mobilization is the hardest. And me, it's a bit on. And it will be from the perspective basically of public finance with a policy mandate and how that can help mobilize. But I would premise that with saying at the end of the day, the entire idea of public development finance increasing, including mobilization of private finance, is premised on the fundamental objective of supporting developing countries achieving development and sustainable development in a transformation. So that is transformative in its own right. And I think this programmatic approach that we heard about, focusing on policy enabling environments, focusing on capacities, focusing on resource mobilization, all has to come together around that. But let me maybe try to categorize three ways that I see, the issue of the transformative finance. And the first, I think the most basic one is really to say, if we look at developing countries, supporting them in just fundamental capacities that constrain them or enable them to, formulate policies and implement them and take action, basically. And these are really the basis, and we're talking about a big spectrum of developing countries, obviously, but that is the fundamental basis of the ability of a country to act, including to act in providing an enabling environment then for the private sector to come in. So that maybe is the first base. Second, and I think that's the focus that we've heard here, is about private mobilization of private finance. And there I would say the key principle around, we have always thought at the OECD about that, is really around the market creation. Because the point is that if you have solved that problem, you have solved the issue of a financial constraint for that market. Because if you can have a successful business case of it, out of it, that aligns with the policy objectives on climate adaptation or mitigation, the market generates the finance and it generates the solutions in a way that is financially sustainable and that is also sustainable in terms of, it's contributing to the policy objectives and also to development more broadly. So that is the fundamental idea why, the focus in terms of deploying public resources in a catalytic way for the mobilization should really be geared towards that market creation, where you say, okay, that can look very different in different markets. So you can have a high degree of concessionality and limited mobilization at very immature markets or so. You can have a much lower degree of concessionality and maybe no concessionality even where it's required. And looking at phasing out in higher income markets, upper middle income countries or so. But the bottom line is that you should see a progression, over time, where you say, okay, we see that we're moving toward that market creation. So we have a first intervention, maybe, where we use a bit more concessionality. Then we really about market creation. Now the third point, it's also been mentioned, is to say, well, fundamentally, what is transformational? I think what is really transformational is if we have cost-reflective pricing, because at the end of the day, the reason why we have the climate crisis is because we do not have cost-reflective pricing. We have, externalities that are not internalized into economic and financial decision-making. If we had that's probably never going to be achieved in a perfect way. But if there's ways of doing that, you change the entire systems and the inherent incentives towards investments that are much more aligned with the objectives of the Paris Agreement and with sustainable development. So in a way, that remains a great, I would say, of transformation. If we move to that, will be still the great thing. But in the meantime, there's lots of things to be done on the other two fronts. Thank you very much.
Thank you so much, Jens. I think you really well summarized the two previous interventions by this notion of market creation, which is key, and the notion of cost-reflecting pricing. We are all working on climate finance, and everybody knows that it's cheaper to invest now than later, but it needs to be understood by all the actors working on this topic. So thank you so much. We were supposed to have an intervention by Sarah Bendaou, who is representing Mainstreaming Climate in Financial Institutions Secretariat. She's not able to connect online, but I'm going to give the floor to Alexis Bonnel, who is also part of this coalition, and this is the beauty of partnership. It can be replaceable. So Alexis.
Thank you. I can do it from here. Can you hear me? Yes. Thank you so much. So I'm one of my hats is that I'm part of the coordination group of the Mainstreaming Climate in Financial Institutions initiative, and because of technical issues, we were not able to connect remotely our colleagues from the secretariat of this mainstreaming initiative, which is hosted by the Institute for Climate Economics. So sorry for this, but they shared a few messages that I'm going to read to you so that we can also contribute as one member of this coalition that is working on the promotion of transformational finance for climate and its characterization. We can also have a few insights from the mainstreaming initiative. So this initiative is convening a diverse set of actors, both public and private financial institutions, bilateral, region, multilateral, from developed and developing countries. And it's quite unique because even though it has about 60 members, it's a proxy of what could be a broader discussion between public and private financial institutions about how to fully integrate climate in all of what financial institutions do, which is the objective of this mainstreaming initiative. And it joined the Making Finance Work for Climate coalition because it was seeing there an opportunity to strengthen this collaboration between public and private actors and bring it to another level. This coalition is indeed unique in bringing at this scale such a conversation between the major public and private financial networks and connecting with others like the GCF and other partners to discuss this particular very high quality type of finance that we're talking about, which is the one that can help unlock a lot more. And also the interest of the Mainstreaming Climate and Financial Institutions initiative here in this conversation is that this can lead to fostering shared methodologies, consistent standards, joint action, and accelerate alignment across financial flows to enhance the overall transformative effect of climate finance. So I think that was picked up already by previous speakers, so I won't develop too long here. Just one last word from the Mainstreaming Climate initiative. There's been also some analytical work that has been carried out regarding the characterization of transformational finance for climate. And there are a couple of things there that are worth of interest for this conversation. First of all, one could see transformational finance as being something that can help mobilize private finance. It is, absolutely, it's central. But it can even go beyond that because it's at the end looking at long-term effects regarding the acceleration of countries' strategies and pathways. One way to do so is absolutely through the mobilization of private finance, and it's a major element, major component. But there are probably a few other things that transformational finance can do, which are not directly connected to the mobilization of more private financial flows, and that can also be of interest for this acceleration of the implementation of country strategies and pathways. And if we look at the key attributes of transformational finance, these are long-term relevance. So long-term is really the compass that needs to guide us here when we're looking at transformational finance. Of course, impact that is at scale and that is systemic. And last but not least, and I will stop there, an impact that is sustained over time. Sometimes you are engaging in interventions where you think, oh, this has the potential of bringing quite a lot of transformational effects. And then you realize it's not very robust, it's fragile. A change in political economy and the thing drops. So one of the key features also of transformational finance is that you are maximizing chances that it can be sustained over time, and that the effects, the ex-ante effects that you're looking at will have a very high probability of actually being implemented. I'll stop there. Thank you so much.
Thank you so much, Alexis. It was clear, speaking about long terms and methodologies, and I'm gonna end this first panel, and I wanted to ask for a round of applause for our very good panelists. Thank you so much. We know now what is transformational finance, and we know that collaboration is key, efficiency too. And I would like to invite the second panelist. We will have Ms. Gaia Larsen from the Global Climate Director at WRI. We will have Mr. Alain Bovillard, Director, Department of Strategy, Policies and Innovation at the Green Climate Fund. Ms. Siloshini Naidu, Head of ESG Development Bank of Southern Africa. And last but not least, Mr. Mustafa Kleish, Head of the IDFC facility. Please, if you would like to join us on stage. Thank you so much for being with us. Building on the previous discussions, this session will focus on how evaluation practices must evolve. Know that financial institutions, including public development banks and others, are called upon to deploy more transformational finance. Assessing the performance of interventions aiming for systemic impacts requires new approaches, since such outcomes cannot be directly attributed to a single actor. This makes it essential to design a different assessment framework. PDBs will share how they are beginning to adapt their practices, while also drawing on findings from recent evaluation to outline the direction of this emerging approach. The discussion will also touch on how innovative frameworks could also contribute to climate finance-related accountability. And I will start by asking Gaia from WRI. You are doing a tremendous work on analytical work on transformational finance for climate. How could you put into practice and evaluate high-quality financial intervention aiming at systemic effects?
Yeah, good question.
That's why I'm asking it.
Yeah, thanks. Can you hear me? Because okay. Good. Well, it certainly builds on the last conversation, right? Because before you measure something, you have to know what it is you're supposed to be measuring. And I still think we have certainly had a lot of analysis around what's transformational finance and moved along in that path of defining what it is. But I still think that it's a challenge is that it really depends on who the actor is, first of all, right? So everyone has different roles to play in the ecosystem. And so one actor is able to, I don't know, come in and give grant financing to help create new regulatory frameworks within a country, or provide some sort of policy-based finance. Another actor is, well, mostly provides like market rate finance and does not do that, but does other things that are a lot more. So I find it challenging to think of one framework or one metric that one would use for lots of different types of organizations, right? But could there be a framework or metric that somehow measures multiple, like how you as an institution are operating in tandem with others, right? So if your role is to provide the grant finance for the technical assistance, is there a framework that said, yes, I've done that, but I've also engaged with, these institutions, and we have a whole map of activities that are happening. So you're not just looking at what you're doing, you're looking at what the other people are doing as well. So that's trying to get at that notion of there's not one definition. And honestly, I mean, if we try to make one definition, I think it won't work, because how do you go and tell somebody also who's, providing project by project financing, but to individuals who really, really need that financing, that no, that's not transformational because whatever, it's not enough people that are impacted or something like that, right? So then the other piece is, if we're looking at transformation, now I'm sort of going from, there can't really be one definition to, but here's one definition, so that's not really fair, but I'll do that anyway, that jump. If we're looking at it as systems change, right? So rather than individual financing, systems change. I think we all probably know at this point that that's a lot harder to measure. And this day and age, we really want to be able to measure impact. And you need to be able to measure impact, so we show results to show that the money that you're investing or that the government is putting in, the taxpayers' money is going to something that is actually resulting in some sort of positive. And it's a lot easier to sell the story, I think, as many know, about I fed this many people who were starving, or I built this many houses that were more climate resilient for people that needed climate resilient housing, then I helped develop a framework for, whatever it might be, improved financial regulations within the country, which will have a systemic impact. So if we can build off, though, existing frameworks that look at that transformational level, and also somehow relax a little bit the notion that results are only results that you can actually, count either dollars or people that were impacted, that'll help us along the way. But I don't have a brilliant solution to it, unfortunately, other than to say we really, there have been studies done, and we can build off of what has been done in the past, but I don't think anybody has found the perfect solution to saying we invested in this thing up here that then trickled down into various different places and eventually had an impact on the ground. But that's what we have to do. And we can, of course, say, oh, we created a new law, or we can create a new institution. And we do like to do that, right? We created another coalition or another institution or another rule or law. But that, as you also know, is also not enough, right, to show impact, because we have so many laws that are not implemented at all. So you have to have this multi-layered process of showing how the investment went into some sort of new change within the government, or whatever it is that we're talking about, and then how that resulted in new investments or changes to the status quo in some way, shape, or form that had a systemic. Now, a lot of times, it's not going to have a systemic impact because it didn't result in that for whatever reason, political or otherwise. And so, we have to also take into consideration, maybe it was a good idea anyway, and you still get credit even if you didn't actually result in systemic impact. Like, we have to allow for failure, because otherwise we're just going to get stuck in like things that are too easy. And if we also can kind of allow ourselves to measure over a long period of time, which is also a problem, right? public development banks are better off than some other institutions where there's sometimes investments over long periods in time and you can measure over 10, 20 years. Great. But a lot of times that's not the case, right? Investment horizon might be 3 years or 5 years, and yet your impact is 7 years, 10 years, 30 years later. And so that's another challenge that we deal with. But if we allow for that long-term thinking, that's also going to help us measure more clearly, not just, oh, we created a law, oh, we created an institution, but what is the long-term impact of that through different political maybe waves and cycles, right? I say that as someone living in the United States, hoping that we have cycles and it's not just linear in one direction. But so that's those random thoughts, right, on kind of the challenges that I think we face in this arena, but it's a good challenge, I think, to try to figure out.
Thank you so much, Gaia. Living in France, I hope that we are going to have cycles too. But yeah, it's you're right. It's a complicated question. What I can take from what you say is that maybe assessing ex ante is easier than assessing ex post, because some cases we would not be able to demonstrate the added value and the impact. But I still think that we need to continue looking for more methodologies, because at the end, and it come back to our previous panel, we need to demonstrate that we use efficiently at least the public money that we have, and that is increasing. Thank you so much for sharing this. Now I'm turning myself to Alain Bovilla from the Green Climate Funds, and I want to ask you a question: how to measure the unmeasurable? Yes, this this is what we had. How do you evaluate finance for systemic change, and can you maybe highlight the GCF contribution to foster paradigm shift interventions?
Merci. Thank you, Nicolas. Can you hear me well? Yes? All good. I will try to give also some ideas about the first panel, because I want to start with that before moving to the GCF. As you mentioned, the first panel, I mean, we are now facing this dilemma on how you can deliver the 1.3 trillion to achieve the NTQG ambition within the next 10 years. And if you look at this dilemma, this is a dilemma we have been having that over the last 60 years in the development and climate finance space. I mean, we have been relying a lot on public and international money there, a lot. This was like ODA focused, ODA driven, and now you see the ODA is starting to drop. We had a peak in 2022, 2023, now it's starting to drop. So there's a question about what's next. And of course, this was mentioned, next is how you use this very scarce money, international public money, to leverage the private and the domestic capacity. And this is clearly like the challenge for us ahead. The private, I mean, we discussed there are a lot of panels about how to mobilize the private sector, and I give you also some tangible examples. We see like three things. One thing is the de-risking instrument. And de-risking instrument very clearly is how basically you bring the private sector where usually they will not go by themselves. Give you an example, you talk about adaptation. Think about adaptation, like 10 years ago, 15 years ago, private sector will never have gone to adaptation. Never. There was no adaptation project. So we started, like institution like GCF, to bring the private sector in this field. A good example is Gaia, the Gaia platform. GCF is putting 150 million equity, basically to create a platform of 1.5 billion with like partner like MUFG, FinDev Canada. And basically this platform is focused 70% on adaptation. Now deployed in 19 countries, they're of 25% vulnerable countries. Can you imagine that? Like 10 years ago, again, private sector, we have never gone there. But here, we are bringing basically the first loss, and we can bring the private sector there. Second thing is beyond the de-risking, is the market creation. This was mentioned. Again, look at the history. 20 years ago, you were talking about developing a solar power plant in Egypt or in Morocco. The private sector will never go there. So you had like basically players like the BRD, like the African Development Bank, developing like solar power plant like Benban, which is now one of the largest one in Egypt, as you know, and created the market. And over the time, you have the cost and the scale effect that is like helping, and now the solar panel power plant are mostly focused, or mostly like financed by the private sector. We're doing the same in the nature-based solutions. Mirova, we just launched a fund, Sustainable Land Management. Mirova Equity Fund, 400 million. GCF is bringing 20%. Again, these are like space where usually the private sector will never go. Third thing of the private sector, this is the cost. This was also mentioned by my OECD colleagues. How the cost is reflected in the pricing. Actually, the risk pricing is the key issue. Maybe many of you have seen the very recent release of the GEMS database. What is the GEMS database telling us? GEMS database telling us that investing in emerging and developing economy is not necessarily riskier than investing in developed economy. This is basically a database which is getting all the track record of the last 20 years of the MDBs, the default rates, and you see that basically the default rate is not necessarily higher. So the premium that has been paid in terms of risk premium is much higher than what we should really pay in terms of risk. Yeah? That means also that the concessionality that we're putting in this project is probably wedged too high compared to what was needed. So there is at the moment a paradigm shift in terms of the private sector investment in this kind of economy in several sectors: adaptation, emerging and developing economy. The second thing is the domestic resources. And here, when we talk about domestic resources, people think mostly on money. But I want to add money, but also capacity, local capacity. Yeah? And we believe that finance in common and IDFC actually are the right tools to leverage the domestic resources. In terms of money, of course, but also in terms of people and capacity. And also in terms of knowledge. Because the people that you have on the ground, like look at a partner like the BNDES. They do the local network in terms of political network, in terms of pipeline, in terms of economic network. And they are actually probably the best players to invest locally in Brazil and in South America. So FIX is for sure one of the main instruments. The second big instrument, and we are pushing a lot for that at the GCF, are the country platform. We just launched an hour ago, like almost 15 new country platforms with countries, partners countries. GCF is just providing the finance for them. They're designing their country platform with their own people at the core to define their priority, their project pipeline, and GCF is just here to help them. And then they can finance the project that they want with the partner that they want. Yeah. So we believe this is putting back basically the country at the core of the story. Now talking about transformative approach, and here I want to thank Alexis for the excellent work we've been doing together when we released this report few weeks ago. You rightly mentioned, Alexis, about long-term at scale, and it's also about like a common methodology. We are releasing actually a report now with all the climate funds to have a common methodology on how to measure also the impact on the ground. But we believe that if you want to achieve the transformative changes, they should actually happen at country level. Of course, the GCF can monitor how much emission we reduce, how much people we are protecting in terms of adaptation and so on. But in the end, what is really the transformation should happen in the country. And I'm very impressed when I look at the NDC 3.0 that are now launched. I was like with Rwanda, with Somalia. I was when Brazil launched the new NDC last year already. I mean, if you look at the figures, they are talking about reduction emission by like 40–50%. This is like extremely ambitious target. And when you look at the leadership which is behind, they're like minister level, head of states level pushing for that. And what is even more impressive is that they are taking the full leadership in terms of implementing that. They don't rely on external partners. They don't say, without the GCF I cannot work, without the World Bank I cannot work. They said, we are taking our own destiny, our own orientation, strategic orientation in the driving seat. And this is the most impressive first. So that means when we'll start measuring the impact, of course the GCF can measure impact, the World Bank can measure impact. But what's the most important is the country itself measuring the impact and being able to see how they're progressing against their own targets. Thank you.
Thank you so much, Alain, for explaining the great work by the GCF. I want to recall the leverage that you try to provide. I think it's important. You also mentioned the necessity of de-risking that is key in this initiative of transformational finance. The GEMS database, notably, to add that it's not only multilateral development banks now, it's also national development bank that is super important because of the fact that, of course, when when you are talking with multilateral development banks, there is the preferred creditor status. But even with the national development banks, without the preferred creditor status, you demonstrate that yes, investing into developing economies is not so risky, and that's why we need guarantees, de-risking tools, such as, and I know that you are discussing with this new PDB guarantee hub that you will not normally join to provide de-risking tools for the public development banks and to better attract the private sector into those economies thanks to the public development banks. And last but not least, China just released their NDC today, which is also very ambitious. So thank you for all of this, and last but not least for releasing those country platforms that we believe a lot in it. We are discussing with you. I'm now turning myself towards Ms. Silishoni Naidu. You are the head of ESG at the Development Bank of Southern Africa, and I want you to bring the perspective of public national development bank on transformational finance operation. You have a perspective on evaluation, and I want to hear how evaluation currently works and what are the reflections concerning the evolution of evaluation to better capture systemic impacts. Do we need new evaluation practices or rather an adaptation of existing ones? And how can public development banks collaborate to advance this agenda?
Thank you. Thank you for the opportunity for us to speak and contribute to this discussion. I'm the head of sustainability, and I'm going to be partially answering on behalf of our head of evaluations. So I hope I do it justice. But firstly, transformational finance calls for new approaches to monitoring and evaluation. Yet I do feel that, especially discussing some of the elements we just discussed now, most of the evaluations are still rooted in previous policy paradigms. For us, evaluations, conducting ex post evaluations, the situation creates multiple challenges that I believe have received very little attention to date. Evaluations of today, it needs to deal with a myriad of external problems, global political forces that are transforming societies, developed and developing. And this is happening at fairly high speeds or high rates of speed. One of these forces are obviously technologies. For example, genetically engineered crops, for example, implications for olfactory and ways of employing people, and so forth. Then there is, for example, the steadily increasing demographic imbalance, if you like, between developed and developing countries, which also it poses a challenge. If you think back to the 1960s, right, qualitative methods were given a lot of attention. And for me, it's still a preferred technique. If you speak to any evaluation specialist, the quest for data and results and the definitions, impact, output, and so forth, and they'll very quickly tell you, no, what you're doing is not impact. It is actually development results that you're doing. And so for me, when you look at the complexity of the issues that we face today, the measures we use to represent concepts such as social justice, fairness, or well-being, it can therefore shed new light on some of the gaps, some of the shortcomings we have on evaluations. Evaluations are supposed to feed to, in my understanding, to directly into policy decisions. But in certain contexts, its instrumental use is not, it's quite rare, actually. So some areas we should possibly focus on is definitely funding innovative evaluations by providing financial support for innovative methodologies to capture, some of these systemic issues that we're just speaking about. Obviously, collaboration between other partners in terms of trying to design these new methodologies and so forth. And definitely capacity building, which is obviously what we continue to do as a bank. But I definitely feel that this will then bring evaluations into this day and age in terms of being more responsive to the needs of transformative society. I mean, data has always been an issue. The quality of program, theory, it really remains critical. Many of them should be more. It still relies on more simplistic, or sometimes, and I don't want to use the word flawed, but I'm going there, and I'm saying some are flawed assumptions about proper program functioning. So at the same time, while new methodologies are, probably necessary, there's also a call for adopting, and adapting to existing methodologies and try to actually be a lot better in terms of informing what is required of evaluations today to align with more contemporary challenges. And this can involve a whole host of new technologies and so forth, change detection models, and really to become more enhancing to evaluations and more relevant for today. So I hope I'll just stop there.
Thank you so much, Siloshini. I think you highlighted the necessity of data, and it can come back to what Gaia was saying at the beginning of the first, the second panel, how complicated it is without data to effectively measure. But I want also to take a bit of optimism. You mentioned the new technologies that could maybe help us in the future better assess those new concept of transformational finance. I'm gonna pass now the floor to have a concrete example of an evaluation. Now I'm turning myself towards Mustafa. Mustafa Kleish, he's the head of the IDFC facility. I know that you have just released the evaluation of the facility, and could you give us a little bit of the substance on the lessons learned on transformational for climate and how this IDFC facility tried to tackle this concept?
Thank you very much, Nicolas. I hope that you heard me very well. Yeah, okay. So thank you first for inviting me to this panel and among our colleagues. I would like here maybe to make to be the voice of my colleagues from the evaluation department of BOAD and IFD, BOAD, which is the Western African Development Banks. This is a concrete example, as you said, of how we can evaluate the transformational impacts of a tool. And let me just explain briefly what is the IDFC facility. IDFC facility was launched in 2019 by the IDFC as an operational arm to help and assist members to do more on climate and biodiversity, to do more and better, not only the volume, but also the quality. This is very important. How we can, as a club, to move forward in terms of climate finance and biodiversity. So it is really on the DNA of the facility to be transformational. And we are not here to implement projects, but working at the institutional level. As we used to say, the IDFC is a tool done by the banks for the banks. And as such, it has this objective of making the club to move forward as a whole. So this is very important to understand. So at the end of the pilot phase, which lasts between 2019 and 2023, so 4 years of pilot phase, during which we explore different activities, capacity building, support on on technical assistance, working on tools, developing tools, and so on. The idea was to evaluate what we have done during these 4 years and understand what is good to maintain for the following phase. So to inform the replenishment of the facility after the pilot phase period. So as I said, the evaluation was carried out independently by the evaluation department of BOAD and IFD. The idea is to have two institutions working on that and having this really independent evaluation. So the evaluation has really two objectives. One is learning about what is happening, and also an accountability objective to understand if we achieve what we said we will achieve at the beginning. So it's addressed 4 evaluation questions. The first is to understand the relevance and the added value of the facility. Secondly, to understand the effectiveness, and this was how the result delivered through the activities are in line with what we expected from during the pilot phase. To understand also the operating model, as you know, we have at the beginning what we set up is a facility with only seconded people from different institutions. So it was a new model of having something which is managed also by the different members of the club, and also the financial models, the financial model to understand how the resources that were dedicated at the beginning to the facility were used, and if these resources were sustainable. So we can say that this evaluation was really a model of a transformational evaluation, because it's offer a clear demonstration how we can promote and how we can make the banks moving forward in something that could be very impacting. This is something very important in that case. And also what we assess is the added value for the members and how this added value was delivered. I used to say that for PDBs, the question is not to deliver only money. With the money, embedded in the money, we have capacity building, we have impacts. We are looking for something that will last after the implementation phase. This is really very, very important to understand. I'm not going to describe all of course, all the evaluation. We will have the summary of the evaluation will be posted in our website. But what give us the lesson learned from the evaluation is that we assess from the pilot phase, we identify those activities that are be sustained and how we can implement them. And it is related to that, to the kind of activities that provide more added value to the members, like how we can not only implement financial loans or financial tools, but also how the banks could develop their advisory capacity, how they can help their clients to develop their projects, how we can not only discuss the project at the last mile, but discuss with the members, with the clients, really at the very beginning, and to construct the project with them. This is important to ensure the sustainability of the investment. So for the next phase, we will build on these findings, and we hope that we will be successful to achieve the replenishment of the facility for the next 5 years, and to continue to support our members in a way that they can transform themselves in a more sustainable manner. I will stop here, but I will be very happy to answer questions if there are. But we will share the summary of the evaluation soon. Thank you.
Yes, thank you. Thank you so much, Mustafa. So in a nutshell, thanks to the evaluation of the facility, you demonstrate that the facility was transformational for the members, going way beyond the project, but transforming them to be able to better finance climate, biodiversity, and way more. Thank you so much for sharing this. We have a little bit of time, so I'm going to ask you a question, but you have 1 minute to answer, if it's okay for everyone. Following our discussion today, what would you change or focus on in your respective activities to help finance work better for systemic climate effects? And maybe, Gaia, not to put you under the spotlight, do you want me to repeat the question? I can do it if you want. Yes? All right. So what would you change in your respective activities to help finance work better for systemic climate effects?
Yeah, I mean, I'm the only one here that doesn't give out any money, so. So
what would you recommend then for the actors that are doing the changes?
Yeah, do a better job, everyone. Yeah. Yeah.
Yes.
No. I think just off the top of my head now, so clearly we have to tell better stories globally at the moment, right? And so being able to tell stories about the results and systemic results in such a way that actually rings true to people and really inspires them is really important. And I think a lot of times we have really important, like you were working on, very interesting elements of monitoring and evaluation, but that doesn't get translated then necessarily into inspiring and interesting stories that make it into the grand narrative of we actually are kind of doing good things around climate and let's keep doing them, right? So I guess that would be one recommendation.
Thank you so much. You want? Yeah, yeah. Please go ahead. Go ahead. No, if you don't want to say the Shini, no worries. It's out of the blue, but.
Thank you. Okay, I think very quickly. I mean, we still, I still believe that in doing your regular climate stress tests to understand the potential impacts of various climate scenarios on the balance sheet, still very important as a bank. Adjusted credit standards, still very relevant, especially in the context of this discussion. Favorable loan conditions to incentivize good behavior, the lower interest rates, being more inclusive in terms of your offerings there. I don't want to go into the carbon pricing side. I still feel there's a lot to say about that. But the shadow pricing element has been up in the air for a while as well. Expansion of innovative financial products, still relevant. Your sustainability-linked loans. I mean, yesterday I was on a panel talking about landscape finance. I mean, now that's a new entire concept. But still, it falls, for me, still within the umbrella of sustainable finance. It's still trying to seek to achieve long-term impact, but a focus on societal benefits. The other aspect, mandatory disclosure, allowing for comparability for investors and regulators, still high on the agenda. In South Africa, we're working very closely now with the ISSB in terms of IFRS S1, S2 regulation in SA. And so, TNFD has also recently, they're now going to be, ISSB's obviously sanctioned their recommendations. So that's also going to create a very good enabling environment, for us to do this type of stuff. And then consistent metrics for sure. I don't know if that exists, but metrics comparability still up there. And then from a regulatory and systemic side, regulators should, they could introduce a systemic risk buffer for, climate concentrations or potentially adjust, capital requirements. So example would be lower capital charges for green assets. Those would be my top of mind kind of enablers or drivers, if you like. But again, the emphasis is on it takes so many sides of the value chain stakeholders to make that happen. I mean, you need an enabling environment that is done through the regulatory bodies. You need a real sector to buy into what you're trying to achieve and to sell. We're working as well quite closely with the Company Intellectual Property Commission in South Africa, because that's really where and what you're trying to achieve. It's going to be done through the support of the real sector. So yeah, those are my top of mind. Thank you.
Thank you so much.
Alain?
Maybe I can take the floor because I would like to echo what
Please.
Seloche was saying
Please,
about
please.
you know the fact that I think for the banks maybe we can call them not only more banks but technical agencies with a credit capacity. I think this is the real work of development banks should be is really to go from a bank position to something which is beyond that as a technical agencies that work hand in hand with their clients to develop things. And I would say that there are some constraints for that because they are impeded by some ratios, you know, as a bank. One of them is to, if they want to develop their analysis capacity, their research capacity, their evaluation capacity, they need to have a staff, experts. They have to have more staff that they have now, and the real, I would say, the real rich advantage, the resources that they have is human resources, and they have capped by some ratios that are impeding the bank to have more staff than it should be. And I think with that, they can really have this impact and they can develop their advisory capacity. They can work more with their clients at the beginning, at the early stage of project development, and they accompany them. I think this is important for the bank stakeholders to work with their banks in order to relax some constraints they have right now to fully deploy their capacity, which are not now the case.
Thank you so much, Mustafa. Alain?
Merci, Nicolas. From my point of view, I think this is a kind of a cultural shift, a mindset shift. And I know that Remy has been working a lot on that. We're coming from a world when it was perceived climate finance, development finance as like assistance, aid. And actually, we should convince now all the partners to move to a world where all these should be perceived as investment in the future. I mean, we are able at the GCF to demonstrate that adaptation could be investable, that nature could be investable. Renewable is obviously investable now. Yeah. And this is our role as, an international institution with a lot of some concessional finance to bring the other partners, convince them that this is like a solidarity investment for the future. And this will be my last word. Thank you.
Yeah, thank you. Thank you so much. I think it's a very, very timely and good conclusion for this panel. Thank you so much. I want to give you a round of applause because it was really, really interesting. I'm gonna turn myself now to Remco because you know that we have this initiative and Remco wants to announce the new paper of the coalition. Remco, please go on stage. Go on stage.
Thank you. Just very quickly, it'll be literally 3 sentences, but I should have done this at the beginning and I forgot and felt bad about it. But of course, you see all these beautiful logos there on the slide, and as Nicolas, you were saying at the beginning, they're not only beautiful because they're very artistic, but they represent a real critical mass of financial expertise around the world, from the public sector. IDFC, public finance, IDFC financing commons, parts of mainstreaming. We have basically have a critical mass of development finance institutions now in this group. And then on the other side of this slide, you'll see ourselves, and I've mentioned we're mostly private finance, mostly commercial banks, commercial insurance. And then you see the principles for responsible investment. The PRI, they actually have something like 4,000 members. They are the capital market, the world's capital market that is there. You put all of that together, and you have more or less all financial institutions around the world, all of them agreeing on transformation, that's the answer, and that we need to finance transformation. And what I wanted to say is that this group not only has a lot of potential, but it's already using its potential because it put out its second position paper. The first one came out last year for Baku, And now the second one, which is a little bit longer, a little bit more detailed, has come out just in time for Belém. It's on the websites. You can find it on the websites of the participating organizations. And in addition to all of the content that we've been covering and all of the substantive questions that we've been covering today and etc., it also starts looking a little bit into 2026 and beyond in terms of what can this community do and contribute. And there's three things that we are proposing. Number one, we would like to propose really a global dialogue. We already have the finance sector basically through this platform at the table. Can we bring other in parts of think tanks, etc., at the table? Can we bring more people, parties, the real economy, civil society more at the table? We need a global dialogue on further characterizing, further understanding, further detailing what is this thing called transformational finance for climate? What are the different manifestations, number one? And then, of course, want to promote that because we're all convinced that that is the future, that is the solution. We want to promote global adoption and the shared definitions and the shared frameworks. Then hopefully, as quickly as possible, we can also achieve an integration of these concepts and these ideas into these international policy frameworks that are being developed here as we speak, whether it's under 21C and the Sharm el-Sheikh dialogue, or whether it's the NCQG and the Baku to Belém roadmap. And then at some point also perhaps even going beyond climate into other challenges, because there the financial challenges are very similar. It's not only a climate problem, though it's probably most acute right now on climate. And so if you want to read more about this, go to our websites and the PDF is there waiting for you. Thank you.
Thank you so much, Remco, and really excellent job to be able to release this paper timely for Belém. I just want to tell you that this journey is continuing and ongoing. We have on Monday at 1:15 in the side event room number 6 an event Unlocking Finance for Climate, from the Baku to Belém roadmap to systems transformation. And of course, we're going to continue, and you said it, Remco, continue our activities in 2026. Stay tuned, and thank you so much for the very good discussions. And I invite everyone to take a picture, if it's okay for you. Quick one, because if not, without... Yes, a picture now. Yeah, picture now. Picture. Yes, of course. If there is no picture, it didn't happen.